Welcome to the weekly market wrap up by primewealthfinserv. This week was full of market twists and turns. Sharp decline, key support levels tested, and a strong recovery marked the action. In this wrap up, we will cover market moves, sector trends, and a key concern with SIP trends every investor must know. So, let's get started. Where is the market headed? The week started on a cautious note as global and local uncertainties impacted the market. The Nifty dropped below 24,500 mark midweek, hitting a low of 24,180, but bulls made a strong comeback, pushing it close to 24,792. For the week, the Nifty gained 0.89%, showing strength despite high volatility. Bears tried to take control early in the week, but bulls fought back, indicating the potential for further gains next week. When it comes to broader markets, the Nifty Next 50 held its support and ended with small loss of 0.6%. Mid-cap indices dipped 0.11% and small-cap indices fell 0.36%. The Bank Nifty followed a similar pattern, starting weak but recovering strongly to close the week with 0.69% gain. Its weekly low now acts as a key support level for short term. Now let's take a look at the sectorial performance. FMCG stocks led the gains this week with 1.3% rise driven by strong performance from key players like ITC. Infrastructure and consumption sectors also did well, each gaining 1.2%. Private banks showed strength, closing the week at 0.8% higher. However, some sectors faced challenges. Metals were the worst hit, falling 0.7%, primarily due to global commodity price pressures. Real estate, pharma, and PSU bank also saw some minor correction with losses of 0.4%, 0.3%, and 0.2% respectively. Despite the mixed performance, the market remains stable and is consolidating for potential upward movement in the coming weeks. Now, story of the week: alarming SIP trends. Let's talk about a rising concern for investors, the SIP stoppage ratio. SIPs are one of the best ways to invest in the markets because they allow disciplined, regular investing without worrying about the market timing. However, recent data shows an alarming trend. In November, 39 lakh SIPs were stopped, almost equal to the number of new SIPs started. The SIP stoppage ratio is now at 80%, meaning 80 SIPs are stopped for every 100 new ones started. This shows that many investors are stopping their SIPs even though SIPs are designed to work best over long term. Why is this a problem? 70% of SIPs are stopped within 3 years and 40% are stopped in the first year. This means most people don't give their investments enough time to grow. SIPs work through the power of compounding, which takes years to show results. When stopped too early, investors lose the chance to see meaningful returns. Take the COVID period as an example. During pandemic, many SIPs were stopped as market fell. However, those who stayed invested benefited when the markets bounced back strongly. This proves that patience and discipline are critical for success in SIPs. So, what's the solution? Here's how you can avoid falling into this pattern. Stick to your plan. Don't let your short-term market movements make you panic. Don't chase returns. Avoid switching funds or investments based on your last year's best performers. Give your SIPs time. Stay invested for at least 5 to 7 years to let compounding do its magic. By following this approach, you can stay disciplined and ensure that your investments grow steadily over time. To sum up, this week's market movements remind us of the importance of staying calm during volatility. Thank you for watching Weekly Market Wrap Up by Prime Wealth Finserv. Please like this video and subscribe to our channel. Thank you.